Well, good morning, everybody. Thank you for the invitation to speak to you today. The conference theme, specifically increasing the resilience of our communities and ecosystems to climate impacts, is fundamental to Ireland's well-being over the next century. I don't feel the need to explain to this audience why that statement is true, nor the need to justify why the central bank is interested in the impact that a changing climate is having on the way our economy produces the goods and services that people want, on the type of infrastructure we need, on the way our financial system functions, and, quite simply, on the way we live our lives. Climate change is affecting the economy, and it is affecting the capacity of central banks across the world to meet their objectives of maintaining price and financial stability and to support broader economic policies. All transitions pose challenges, and climate change is one of the three significant economic transitions we are undergoing right now. I will not talk about digitalization or about demography today, but one characteristic of all these transitions is that the choice to remain as we are isn't available. The status quo option does not exist. What does exist is the opportunity to manage the transitions. In the case of our changing climate, the world has decided that it wants to manage it by prioritizing the decarbonization of our economies, as, to state the obvious, the alternative isn't appealing. But time is not our friend here. The world agreed in Paris in 2015 to limit the increase in the average global temperature to 1.5 degrees Celsius above pre-industrial levels by 2050. As things stand, climate scientists are telling us that the world is not on the path to achieve that. In fact, we're not even going to limit the increase to 2 degrees. Last year, the UN concluded that the world was on track for an average increase of 2.9 degrees. And even that will only be achieved if all commitments to mitigation measures are implemented by governments. In other words, we are heading for a global temperature rise far above the Paris Agreement goals. And those somewhat grim facts tell me two things. First, we must carry on with the transition to net zero. And second, we have to plan for a world that is going to have a different climate to that we are used to. The speed and depth of decarbonisation targets are unprecedented, but they are also technically feasible and without doubt represent the lowest cost route for society in the long run. Climate change and climate damages should peak this century if the globe meets its emissions targets. Until then, we will also need to adapt. The need to adapt, the need to transition to something different, is uncomfortable for households, businesses, and the community as a whole. This is understandable given the scale of change ahead. However, as a society, we should also take time to visualize the endpoint. A country with almost no emissions, cleaner air, cheaper energy, less energy poverty, and most importantly, part of a world that is on a sustainable environmental pathway that is safe for the next generation. And there are also clear economic benefits, but let me mention just one. Over the past 10 years, 65 billion euro left Ireland through energy imports. By 2050, Ireland has the potential to be a major renewable electricity exporter. So let me just take a few minutes to describe how we view climate risk in the financial sector. The health of the financial system is directly dependent on the health of the economy, and climate change has real and significant consequences for our households and businesses. Take, for example, a major flooding event in an industrial estate. Affected businesses experience damage to machinery, stock and buildings, and disruptions to production and output. Depending on insurance coverage, such an event has implications for business costs, for insurance coverage, for revenues, and ultimately profitability and jobs. Such impacts are felt by banks in two ways. First, the likelihood of any existing loans being repaid has instantly declined, and second, if the loan is secured by physical collateral at impacted locations, the flood event has reduced the value of the bank's security and also the borrower's future access to credit. It's already very clear that future flood risks are unevenly spread across the country, with only specific areas in certain sectors being vulnerable, and which will require targeted policy intervention. The decarbonisation of the economy also has financial sector risk implications. Businesses and households will need to do more with less energy and switch to lower emission inputs and fuels. Such changes are only possible with new investments into new technologies, and these investments will probably require external financing. For the financial sector, these transition risks encompass the negative changes to business costs, to revenues and profits as a result of government policy or future climate-related shifts in consumer or investor sentiment. Like physical risks, transition risks are also unevenly spread and will be higher in sectors with carbon-intensive inputs, processes, or outputs. Some highly intensive sectors will be required to make very dramatic changes to their business models if they are to survive in the new sustainable economy. There will also be winners in the coming decade. Sectors and countries that offer lower emission products and services will be more resilient. Transition risk differences are prevalent for households too. A family living in an apartment within walking distance to services will have a considerably less expensive transition than one in a large, isolated, detached house. And it's important that transition supports consider these cost inequalities if we are to bring everyone along this journey, although we must accept that some types of business models and assets may no longer be viable commercially. To plan a safe path through the 21st century, we must forecast risk. And while the world should reach net zero this century, there is considerable uncertainty regarding when exactly. It is, however, certain that the frequency and severity of weather and climate-related damages will increase over the next 40 or so years, and sectors and communities will need to adapt to these changes. How much we need to adapt to physical risks depends on which damage pathway the world is on, which of course depends on emissions reductions outside our borders. While Ireland's greenhouse gas emissions per capita puts us in the top fifth of most emitting nations, our small population and land area means we play a relatively minor role in total global emissions, about 0.1% in 2022. Ireland is therefore a physical risk taker, and we must monitor global trends to understand our own future physical risks. Moreover, such statistics should not be used to reduce the urgency of meeting our own mitigation targets. The net zero objective will, regardless of what happens abroad, decouple our economy from fossil fuels and put us on the lowest risk pathway. Over the coming decades, it is of course vital that all countries push towards targets together if we are to avoid a very dangerous prisoner's emissions dilemma, where the pursuit of individual country gains leads to worse long-run outcomes for all. Limited past global progress, both in Ireland and elsewhere, has increased the decarbonisation challenge. The world now emits 50% more emissions per year than it did 25 years ago, increasing the amount of carbon dioxide in our atmosphere by a further 14%. As I said, we're not on track to meet the Paris Agreement's 1.5 degree lower safety bound. Rising temperatures have already led to high damages. The World Meteorological Association estimate that economic losses from weather, climate, and water have increased sevenfold since the 1970s, and Europe is heating faster than other regions and experiencing more intense heat waves. Last year, Greece witnessed the continent's biggest wildfire in history, with very large fires also occurring in Portugal, Spain, and Italy. Damage trends are very worrying and will increase until the globe turns the corner on emissions. Recent mitigation developments bring optimism, however. We may even be in the midst of a transition tipping point. Increased rollouts of solar, wind, nuclear, heat pumps, and electric vehicles is now putting a dent into emissions. And last year, we saw a 4.5% decline in emissions across advanced economies, which is a record for a year with positive economic growth. And looking ahead, we can also trust in technical change. The world's brightest are on the verge of multiple disruptive technology breakthroughs, including next-generation solar, solid-state batteries, green hydrogen, and nuclear fusion. Our uncertainty regarding the path of physical damages is also rooted in global policy uncertainty. The transition is dependent on real economy investments, but only governments can change the technology choice environment and steer the economy to net zero. There is no silver bullet policy when it comes to effective climate policy. But reaching targets on time will be more challenging without international coordination on carbon pricing. We also need to be careful not to prevent innovation that supports the transition as a result of geopolitical conflict, or the misguided hope that autarky through strategic autonomy will somehow put us in a stronger position to achieve net zero. The economic rationale for using taxation to guide the economy is strong, and numerous studies show that the carbon tax approach to decarbonisation will be the lowest cost for society. The transition embodies millions, probably billions, of technological and behavioural decisions to switch from old and emitting to new and sustainable. However, the switch will only happen if the benefits outweigh the costs for individual adopters. And a slow, credible, and predictable increase in emissions taxes raises long-run fossil fuel price expectations, increases the benefits of switching, and raises the incentives for businesses developing emission-saving innovations. We have control of our own carbon pricing, and we are on the right path. But international agreement in this area will be vital for global decarbonisation in the coming years. Domestic adaptation, however, is within our control. This means different things to different sectors, and different sectors will understand their own climate vulnerabilities and specific solutions, from farmers switching crops and investing in water management to domestic manufacturers diversifying their supply chains across more locations. Such solutions lower risk from external events, increase profitability, and protect jobs. In aggregate, adaptation improves the resilience of the wider economy to climate change, which also lowers risk to the financial system. And Ireland will have more frequent and severe flood events over the coming decades. And flood mapping by the Office of Public Works has increased our understanding of this risk over the last decade. Households, businesses, and public authorities now have access to more granular information on flood likelihood, both today and over the next century. And such risks are relatively high here. For example, recent estimates from the European Central Bank show the Irish financial system's exposure to flood risk, domestic and foreign banks combined, in the commercial sector is amongst the highest in the euro area. Where risks are deemed too high, properties may end up being uninsurable, which has knock-on implications for the riskiness of mortgage held by banks. There's evidence that some lenders are already considering these implications, and we've seen, albeit overseas, lenders withdrawing from granting mortgages to properties deemed to be at high risk of flooding. So while global decarbonisation must be the first line of attack to lower physical risk growth, we can also protect our households and businesses by investing in adaptation measures such as flood defences. And first and foremost, flood defences protect communities and livelihoods from severe hardship, but they also maintain individual household and business asset values, increasing their economic and financial resilience. And since 2010, €600 million has been invested in 55 flood protection schemes to the benefit of over 13,000 properties. And additional schemes for which funding has been ring-fenced under the National Development Plan will protect an additional 23,000 properties by 2030. So progress has already been made, but the clock is ticking, and the window of opportunity to take preventative and proactive action may be closing faster than we realize. Impacts from damage are alleviated by insurance. Insurance play a critical role in society, providing individuals and businesses with security and confidence in their daily lives and activities. The insurance market, however, is facing major challenges. Without adaptation, rising physical risks have clear implications for insurers and policyholders. More frequent and severe events will bring more claims, higher premiums, and lower insurance coverage in risky areas. Furthermore, diversifying country-level risks through the reinsurance market is becoming more costly and restrictive, given that climate risks are rising in many regions simultaneously. Recent large increases in household insurance costs in the United States could be a warning sign for other regions. So while it's important to acknowledge these challenges, it's equally important to highlight there are still opportunities for insurers to continue to play a crucial societal role, create sustainable business models, and remain relevant in this fast-changing world. In areas where defences are neither economically or technically feasible, or in situations where defence infrastructure will take many years to complete, lessons from international policy innovations may help prevent a squeeze on underwriting here. And consideration could be given to interim measures that could mitigate flood risk until defence infrastructure is in place. Reducing risk through adaptation allows insurers to retain a risk-based pricing approach and potentially expand risk appetite and offers of insurance. This might be achieved through recognition of measures put in place by policyholders to lessen the risk. Similarly, public-private collaboration, whether it is through the provision of expertise or another mechanism such as a partnership, also enables insurers to retain a risk-based approach to pricing. It may be possible to set up risk-sharing or solidarity schemes where funds are pooled to support insurance provision in risky areas. The financial sector must also adapt from within, which means embedding climate risk into our models, our systems, our processes, and our policies. Climate change has forced the financial sector to consider risk over considerably longer time horizons. For example, up until very recently, a bank stress test would explore resilience to economic shocks over the course of a typical business cycle. With climate change, we're now looking at risk over decades rather than years. This brings new challenges and has required new data collections and new models. The financial sector's information environment is also adapting to the transition, and we appear to be in the midst of a climate risk transparency revolution. Investment flows follow profitability expectations and climate risks, both in terms of the costs of decarbonisation and the likelihood of physical damages, and growing investor considerations. With new disclosure regulations for business and investments, there's now a growing flow of climate data sources. The new information environment, coupled with strong government policy and commitments to targets, should align investment flows with transition goals. And the policy mechanisms within our current prudential framework will also be adapted to contain climate risks. We've made it very clear that we will use all the tools at our disposal to enforce appropriate climate risk management, strategy consideration, and internal governance. While it's a bit too early to conduct a wholesale recalibration of the capital framework, the availability of data and precision of risk forecasting is improving very fast, and if risks are clear, large, and quantifiable, we will have a clear case to act. Such changes would align financial flows with transition risks and support broader emissions targets. So let me conclude. Past climate models predicted the present, and these same models will now guide us back to sustainability. If nations meet their targets, the climate should stabilize this century and take the world off its current dangerous trajectory. A focus on mitigation continues to be essential. An orderly transition is far preferable to alternative scenarios of doing nothing or doing too little, too late. And we need to avoid seeing 2050 as far away in the horizon and concluding that the problem will take a much longer time coming than everyone thinks, only to find it happening much faster than you would have thought. Achieving net zero by 2050 is unquestionably the lowest cost option for society, the economy, and the financial system. Different sectors have different roles and challenges in the transition, but net zero, at its core, is a real economy transition, ultimately dependent on businesses and household decisions to upgrade and switch. The financial sector's role is clear. Private sector investment targets will only be achieved through significant financing, whether by banking or capital markets. Failure to decarbonize financial flows will lead to a build-up of climate risks in the system. Central banks have a responsibility to monitor and forecast these risks, and then to act to maintain financial stability. The government's role is also clear, as it has to steer the real economy to net zero by creating an environment that provides the right incentives and favors low-emission choices. That much we know. We also know that change is coming, and that we can strengthen areas of vulnerability through adaptation. No doubt there are many things we don't know, and we have to continue to rely on science to help us map out the journey. But it's a journey we have to travel, albeit that it will be like, to paraphrase the Greek poet Cavafy, full of adventure, full of discovery, an achievable and worthwhile journey, and arriving there should be what we're destined for. Thank you very much.
Thank you very much. That was absolutely fascinating, and I'm sure there's going to be loads of questions from the audience. I'm not big on my Greek poets, but I don't think any of us want that excitement and adventure. A bit of stability and security would be good. And what we were talking about this morning really has been that climate change is here. And we are experiencing climate change in Ireland. We're seeing extreme weather. We're seeing floods that you were referring to impacting on businesses and homes. And maybe to start off with the insurance sector, because in a way that's an area that impacts each and every one of us. And I might talk about broader environmental and financial connections afterwards. But just when you were talking about that, it really resonated with me, because it is something that impacts us all. We all care about it. We only tend to care about it when something happens, and then suddenly you're looking and you kind of assume that everything will be all right. But can you tell me a little bit more about what the central bank is doing to ensure that the insurance sector adjusts to this challenge of climate change and all of the associated uncertainties?
We've been working with the insurance sector both to sort of work out what it is that they are doing and to help them to understand what we are seeing. And we've got a project underway, actually, specifically around this. I mean, the most interesting thing in the last sort of 12 months or so, 24 months, has been us understanding the degree of underinsurance that exists. So we established that in 2017, I think around 6-point-something%, I can't remember the precise number, of paid claims were underinsured. By 2022, I think, I can't remember the year, that number had gone up to around 17-point-something%. And the result of that actually has been that the industry last year it could be the year before, apologies for not being very precise, actually took the initiative and contacted around 1 million customers, I think, to encourage them to make sure that they understand the degree of underinsurance or not that they have. So awareness, I think at the moment is probably the single biggest thing that we can do, not so much for the insurance industry, but for the whole community to help them understand what risks they have. But it's, as I said in my remarks, I mean, it is a very, very big challenge for the industry.
And ultimately all of us, and then it impacts policymakers as well. I suppose it impacts us all. And the other piece that I was interested in, I will, everybody in the audience start thinking about your questions now, but I was, I suppose, really what came home to me was when you were talking about that reliance on science. And so, for example, the OPW flood risk maps, the EPA is now developing the first national climate change risk assessment, which presumably will be able to feed into yourselves as well. But it's where do you see, and this is the first time we've had somebody from the central bank, for example, at a climate change conference, because, as I said already, the environmental community tend to talk sometimes to ourselves, and I would say the same sometimes with the financial community and other, the sectors as well. We each talk to ourselves. But where do you see maybe an interlinkage, or what can environmental science or the environmental community do to support the work that the central bank is doing, and maybe vice versa, or any thoughts you might have on that?
I think we need to make sure that we're talking the same language, and appreciate the fact that each of us probably has a slightly different language. We have fantastic acronyms, incidentally, and I don't know them all. But let's talk the same language, and let's identify the fact that actually these are all mutual interests. I mean, I think it is just a very narrow-minded and ultimately very negative thinking to actually put everything into silos and say it's nothing to do with me. I mean, the one thing that's very clear is that the problem affects everybody. Understanding, this is not a problem that only affects an environmentalist. It affects the real economy. If it affects the real economy, it affects the financial system. So it affects everybody. And the solutions, the same applies to solutions. So I think, I'd like to think that it won't be long, Laura, before you can't ask a question like that. Okay. Right? Because, I mean, for me, it's like a bit of a no-brainer that if we don't understand. Well, let me put it another way, because I think there is a risk sometimes that we, for good or ill, that we believe that we move away from intelligent thinking into ideological thinking. And we can't afford it in the area of a changing climate. And I haven't even talked about biodiversity, incidentally, and nature science, but we can't afford not to look at the facts and help each other understand what they mean, understand where the gaps are, because there will be gaps. In the work that we've been doing around modelling, we absolutely know that there are gaps, and it's the scientists who are going to help us ultimately. I mean, the financial modelers will have a role to play, but ultimately it's scientists that will help us understand how to improve our models, which will help us to understand risk, which will help us ultimately to understand what's the right what's the rule framework and what are the right incentives to put in place to help this transition. I mean, sorry, but just a final point, because this is something which I want to help make sure everyone understands. It was in my remarks, but there are two things that I'm particularly focused on. One is the transition, but the other one is the fact that it's going to take us time to transition. And in that time, we're just going to have to adapt to a very different climate. And understanding how we're going to live through that period before we complete the transition is also incredibly important.
And I think that piece, the two pieces there, first of all, the common language. And I think absolutely it's really important. And there is a tendency that we all speak in our own language and it's easy and we understand it. And that piece there that you talk, effectively, we all have a role to play, you know, and each of us can bring added value in order it to be in that kind of solution mode. And intelligent thinking versus ideology, again, really, really important in that space. And in the context of transition, it was absolutely peppered right through your talk, and I think that difficulty with transition, because you know it's changing, but you don't know how fast. You know overall know the destination, but it's that uncertainty that I suppose we're all living with now. And you talk quite a lot about kind of that global transition. Are there opportunities you would see for Ireland in the context of a transition? Or is there anything that strikes you that kind of say, you know, that here, you know, Ireland as a country, that we should be grabbing onto and saying, you know, here's a unique selling opportunity for the country or a unique opportunity?
Yes, there are two things that stand out to me. Firstly, we have a voice, and we should make sure we use our voice in international fora. Part of that, developing that voice, is also we need to use it domestically. And let me partly just go back to your earlier question about the scientists and the financial world. I think one of the things that we need to do together, and this is probably more about talking to experts of whatever discipline, is we need to develop a narrative that is persuasive enough for the community as a whole. And I'm a great believer in the power of economic narratives. And I do think that we've lost our way a little bit in the narrative that we use to talk to the wider community. And I think doing something, thinking about how we do that together would be a good thing. But so I think that's my point about voice. But the other thing, and getting straight to what I said at the pretty early start of my speech, and this is speaking personally, it's not the central bank view, and it's not based on any particular scientific prioritization. But I find the proposition that Ireland can become an energy exporter incredibly compelling. Not only because it will help us to manage the climate change challenge, but I think it'll be transformative to the economy as a whole. And I would invest a lot of effort in that. And I know that there are challenges, and I know the planning system is designed to stop any of this happening. But I would encourage us all to think really hard about that opportunity and to just go for it. But that's a personal view.
And it's a very positive narrative, and I think sometimes when we think about climate, we think about all of the negative, whereas here it's such a positive narrative to say, you know, rather than relying on, I think you were talking about spending 85 billion on importing fossil fuels that we could be exporting. So kind of how do we all coalesce around that? And that narrative that's persuasive for a community as a whole, again, a positive narrative, because with all of the, you know, we've a behavioural change section within the EPA, and the more we talk to people and work with others such as the ESRI, you don't change people by fear. You know, people won't change. The people want to change to something that looks better. So I think there is an onus on us all on that. I am now going to turn to the audience and see, I'm sure I see, multiple questions. Maybe start with Frank Convery there, and then I'll go to the gentleman in front. So Frank.
Thank you very much. I love that presentation. Just on your first point about the voice, the voice, I think it'd be terrific if the central bank in its annual report had a chapter headed the real economic transition, and just flag what you see as has happened, looking back, and what needs to happen in the future as a kind of a drumbeat, because the language you've used and the points you've made here are largely absent from the Irish debate, I would say. And it would be terrific if you took that on, because you have the independence and you can frame it in a way that I think could be enormously productive. The second is a question really going back to Laura's introduction of you. I'm a regular visitor to New Zealand and have been to Japan. And I'm struck in both jurisdictions about how the whole earthquake phenomenon is a constant feature in how they manage their affairs. And I'm struck by, and that requires prioritization in terms of adaptation and so on. And I just wondered, in reflecting on your New Zealand experience, especially because you're in Treasury and the government and allocating funds, whether New Zealand and or Japan and that whole part of the management of risk has any insights for the climate challenge we're facing. Thank you.
Well, New Zealand has invested a lot in looking at the climate challenge in itself with its Climate Change Commission, and it's got all sorts of targets and things. But it's interesting you raised the earthquake point, because I think so if people don't know, when I was in New Zealand, I had an app, the GeoNet app, and if I was feeling particularly masochistic, I would look at this app and it would just tell me how many earthquakes have happened in the last few hours. There's earthquakes all the time. And you get used to them, because most of them you don't feel, and even the ones you feel, they're very quick. But in New Zealand, most of us had earthquake insurance. So there's a particular insurance system that they have there. It was tested to destruction when the Christchurch earthquake happened. But it relies massively on reinsurance overseas. But there is a system of insurance. By the time I left New Zealand, the number of earthquakes, the types of earthquakes, believe it or not, were changing. And they were challenging building construction, and some insurers were withdrawing from the market. So it's becoming potentially problematic. So, a bit of a long answer. I'm certain that there are things that we can learn from what's happening in New Zealand, or has happened in New Zealand. I can't speak about Japan. But how the insurance market developed there around earthquakes, and where it is today, I've been away for 5 years, so where it is today would be very interesting.
And just on the annual report, that plea
sorry,
from Frank.
I will take that away.
Great. And I should say as well, the central bank for a number of years now had a climate forum that brings a wide range of different stakeholders together, and that's been really positive, certainly from my experience on it. Sorry, the gentleman in the front, and I'm conscious I'm going to look to colleagues because they're going to say to me in a map, it's in 5 minutes, so we'll have a few more questions.
Noel Buckley, I found it very interesting, Gabriel, to quote you said, failure to decarbonise financial flows increases financial risks. And I was fascinated throughout your presentation, there wasn't one mention of the fossil fuel industry, because that's the major contributor to climate change. And I've sort of 3 questions around that. Number one, in your experience, is money moving away from the fossil fuel industry? And secondly, is a country or a company, in terms of risk assessment by the central bank, is it identified as a higher risk by its dependence on the fossil fuel? And what is the central bank itself doing to encourage investors to de-invest from fossil fuel and into the new technologies that are really the future? And lastly, lastly, you mentioned about the planning process and the potential transformation of Ireland as an energy export. Do you think investors will have the patience to stay around with the delays that investors experience in terms of wind farms and so on? Thank you.
Well, my answer to your last point, I mean, to put it frankly, is we need to change our planning system. And not just for wind farm, but we just need to change it. So money is moving away from fossil fuel, but much slower than I think anyone would want, but it is moving away. But the evidence around the world is that in some parts of the world, money is moving into fossil fuel. And that's driven by for all sorts of reasons. The central bank, we are not going around saying, Bank X, you've got to get out of fossil fuel. We're saying, Bank X, do you understand the risks you're carrying and how you're managing them? But as you said, there is a connection between fossil fuel and the risks. And we ourselves are, as part of the in ourselves, we are looking to decarbonize our own investment portfolio. And as part of the European system of central banks, we've got a whole program of doing that together. And we also have, incidentally, one of the most environmentally efficient buildings in Dublin. I assert confidently, I may be wrong, but it's won all sorts of awards, so we're very proud of it.
And I'm going to have to, I would love to, I'm being instructed here, I will be absolutely killed. I would love to stay here all afternoon, but we're going to have to leave it there. Thank you so much. Thank you so much for your time. Thank you so much for your engagement. And I think it's been absolutely fascinating and a huge opportunity for further engagement into the future. Thank you very much, Gabriel.
Thank you, Laura.
Thank you. Thanks so much. It's really appreciated.